out there. Mr. Matt, how you doing this morning? Oh, that's why you can't hear me. Okay.
I forgot to put my headset on. I'll- I don't know what that says about me. Maybe I need long-term care. I don't know.
Yeah.
I shouldn't joke. I should not joke. How are you? How's your day going?
Good. Busy. Beautiful day.
Yeah, it's
Beautiful day.
wonderful out, isn't it? I mean, just this weather here in San Antonio today. So, for those of you who might be watching this in the future on our YouTube channel, we're recording this on September 11th, 2024. So, sad day in American history, but a beautiful day here today in San Antonio. I think the high is only going to be like 85, which for us is just fantastic. So, beautiful day. We are going to talk long-term care today. This is the third presentation in our retirement readiness series. A lot of you have seen our Social Security workshops either in person or virtually. The workshop that's previous to this focuses on Medicare, which Ken ran for us last week. This week, we're going to just talk long-term care. I'll do the bulk of the presenting. Ken's going to interject with a lot of insight and comments as we go. But just a couple housekeeping items for everyone. If you want to ask questions during the workshop, please feel free to do so. You can do that in the chat. While Ken's talking, I'll monitor the chat. While I'm talking, Ken will monitor the chat, so you'll get your questions answered in real time. We're scheduled for an hour. What do you think, Ken? 40 minutes tops?
Let's hope.
Yeah, somewhere in there. It won't go for a whole hour. But the goal for today is just to teach you about long-term care so that you start thinking about developing a long-term care plan. And that's what we're all about at Mission Financial Planners, is helping you develop the plan. It is not to say that you have to buy a long-term care insurance policy. It is to say that, hey, you know what? We have given serious thought to what it's going to cost, what that might mean for lifestyle for us and our loved ones, and here's what we want to do to address that issue. If you've given serious thought to that, then yeah, you probably have a good plan. A lot of people haven't, though, and we'll talk about some of the reasons why people don't really want to think about this. Ken, anything you want to add before we jump into it?
No, I think that that's exactly it, is being informed and being prepared. Uh, that's it.
All right. Well, let's jump into it then. So, Ken, I'm going to ask you, and Ken knows the answers to this, but we're going to go ahead and just ask him anyways. So, Ken, how many Americans over 65 are going to need long-term care? Is it
So
3, 8, or 70%?
So the most recent study that came out says that 70% of Americans are going to need some form of long-term care assistance over their life. So there's a lot of y'all on the call right now. 7 out of 10 are going to need it.
That's staggering. It's just staggering. And some states have even put rules in, like the state of Washington, where you basically have to buy long-term care insurance or you have to pay a tax, right?
Absolutely true.
Yeah.
And California, I think, is in the process of adopting it. If not, they've already adopted it. But it is a major concern, not just for you and your household, but for all Americans over the next 30 years. And being prepared will make it easier for you and your family.
Well, and Ken is absolutely right. 70% of Americans, and it's being prepared. That's the key. All right. Second question. What's the percent of Americans who think it is very likely they will need long-term care at some point in their life? So this is trying to draw a distinction, right? You can see the three options, right? 3, 8, or 70. So there's a big drop off between who's going to need it and who thinks they're going to need it, because we all think we're bulletproof to some extent. But Ken, what percent of Americans think it is very likely that they're going to need this?
So while 70% are going to need it, only 8% think they're going to need it.
Exactly.
So there's
Exactly.
so of the 7 out of 10 of you that think or that are going to need it, really only one of you has thinks it's going to happen to you. The other 6 are going to get blindsided.
Yeah, and that's that whole I'm healthy, I've been healthy, my parents maybe never had to deal with something like this, you know, but that doesn't mean that something isn't going to happen, right? That's a huge issue, right? Is having the, I don't know, is humility the right word? to just recognize that, you know, just your experience is going to be different than other people's, and most people end up experiencing this. So, all right, last question, because it's a process of elimination. We're there. Percent of Americans who actually have gone out and bought long-term care insurance, it's only 3%. Like I said, though, the focus of this workshop today is not to tell you to go buy a life insurance policy with a long-term care rider, go buy a long-term care policy, go buy an annuity with a long-term care rider. You know, those are certainly great options for you. But again, if you have a great plan, you don't need that stuff, right? You just need to make sure you have a good idea of what it is you're dealing with. So today's workshop is called Getting Long-Term Care Planning Right. I'm Matt Donahue, Kenneth Hamilton. We are both certified financial planners. We are both with Mission Financial Planners. We also hold a couple of what I think are interesting credentials that, believe it or not, tie right into this. So Ken and I are both also certified in retirement income planning, which means we can build out plans for people that can incorporate something like the extra expense of paying for long-term care for you or your spouse at some point in your life. What's the impact of that on your overall retirement accounts and your lifestyle? And so we can build that stuff out and take a look at it with a fine-tooth comb. I'm also certified in long-term care planning itself. And so I can take you through at a pretty deep level how long-term care planning really should be conducted and what are the differences between, you know, all the different solutions that are out there for it. Where Ken has another credential, though, that I think really does matter as well. And it's especially because there's, you know, the most common age cohort that gets divorces these days is people 55 and older. Well, Ken is also a certified divorce financial analyst. So if you're going through a divorce or contemplating going through a divorce, is your attorney well-versed enough in this to understand that, hey, you know, one person might be going with the bulk of the assets, whereas the other person's getting some income, but what's going to happen when you need long-term care? How is that going to be addressed? Right. So, you know, and I certainly don't want to speak for Ken in terms of that, but these are some of the considerations that we always need to be thinking about when we're doing this planning. How does it fit into my overall income plan for retirement? How does it fit in my lifestyle goals for retirement? What if I'm going through a divorce? How do I make sure I'm not exposing myself to this risk unnecessarily as a result of that divorce? There's a host of questions you do need to ask yourself. And if anything, you know, Ken, I'll throw it over to you for a few minutes here. How many people's goals, dreams, plans, and situations are exactly the same?
I mean, almost nobody. Again, today's 2024, September 11th. Who thought 25 years ago, in the 1999 at the peak of the dot-com bubble, that everything would have unfolded over the next 25 years? Everything from a terrorist attack to 3 years of a bear market, the financial crisis right afterwards, some gas crises in the early teens, an amazing bull market, only for a global pandemic, a trade war, and everything else in between. Who thought that they would be sitting right here talking virtually on a meeting 25 years ago? Who knows how we're going to be communicating 25 years from now? Who knows how your health, what technology, what medicinal tools and resources are available 25 years. But the thing is making sure that you have a plan that's as flexible as possible for all the curveballs, bumps and bruises, minefields, whatever analogy you'd like to use in this. But things are going to happen that are unexpected. And what are we doing to be ready and nimble enough to adjust to them?
Yeah. Yeah, that really does come down to it, because like you can see here, it is a confusing and unaddressed challenge for most people. And like Ken said, nobody knows what's going to happen in the next 25 years. I mean, it's a perfect segue, if you will. I mean, it seems like it's a remote issue. I'm 60 and I'm healthy. I'm 45 and I'm healthy. Why should I be thinking about this? That then tends to lead into a really false sense of security. And some people, and I won't take you through the whole list, but some people just assume their family's going to take care of them. Folks, we met a couple a few years ago that the lady in the relationship said, well, my niece, my daughter-in-law is a nurse. she's going to take care of us. And I asked her, does your daughter-in-law know that? And you could tell just by how uncomfortable that made her that they had never had that conversation with their daughter-in-law. And it became really clear when I asked her, well, what kind of nurse is she? And it turned out this nurse was making $150,000, $180,000 a year as a nurse. And then when I asked the question, so is she supposed to quit her full-time job to take on the full-time responsibility of taking care of you when you're not able to do it yourself? And the lady looked at me, and Ken was there. The lady looked at me and was just like, well, of course not. Well, okay. So what is the plan in that case, right? What is the plan? So again, you got to have a good plan in place that works for you. I touched a little bit on this, in those comments I just made. There's an emotional and a financial side to this. You might have seen our recorded version of this workshop from last year where I talk about my family. I live here in San Antonio. I have 2 kids. My wife has a full-time career. Between Ken and I, we own 2 businesses, right? We're going 180 miles an hour all the time. And my family's all from Minnesota. My sister still lives in Minnesota. My parents live in Minnesota. They live about 3 hours outside of Minneapolis. They are 86 and 81. When something happens, it's going to fall on my sister. I'm 1,500 miles away. She's 3 hours away. How many 3-hour-long car rides is she going to have to make where she has all this time to think about, why isn't Matt able to do more? Why does Matt have to live in Texas? That's going to build resentment over time. That's just human, right? So there's a huge emotional toll that comes with this. And in fact, there's a lot of data out there that shows the primary caregiver, if you think you're going to take care of each other, let's say you're in your 70s when something happens, or in your 80s, there's a load of data out there that the additional stress it creates for the spouse who is healthy, the spouse actually dies before the person who has the long-term care issue dies. So there's this huge emotional and physical toll on your family if you don't have a good plan. That means that it's not all on your family. Doesn't mean they're not involved. Doesn't mean that they're not helping you plan. Doesn't mean that they're not supervising the care that you get. But if they're working a full-time job and then up another 10 to 12 hours a day where they're getting maybe an hour or 2 of sleep every night, hey, that's the kind of thing that happens when you have a newborn at home. But the thing about newborns is they typically grow out of that within 3 to 4 months, and you get through it. And then that 3 to 4 month period is just kind of a blur that you don't really remember a lot about what happened, right? Well, that's not necessarily the case here, because this could go on for 5 or 6 or 7 or 10 years. So that emotional and physical toll is pretty strong. Ken, do you want to talk about the financial toll?
Absolutely. Yeah. When it comes down to it, there are a lot of unintended tax consequences to your family when you're needing to take out all these assets. If you are liquidating from your IRAs, well, that's additional tax income. If you're needing to take a home equity loan to cover some of these costs, again, what is that overall impact going to do to your state when you finally do pass away? And with minutes, hours of planning, just laying down, stacking the dominoes and see how they would fall, provides a level of clarity to see what some of these are. And while what we've found is when you can understand the financial upper and lower limits of what's possible, that in and of itself reduces some of the emotional parts of it as well. So just being informed and in looking at the financial impact can be really beneficial as well.
Yeah, absolutely. Right. Well, here's one of the keys we're going to talk about. Long-term care planning does not mean you're going to a nursing home. The vast majority of people will never end up in a nursing home. Okay. Most people who go to a nursing home, it is because they're either at the hospice point, which means end of life, or they're dealing with some kind of rehab issue from an injury or an illness that requires that they have 24-hour care for a period of time. Long-term care is actually just a host of services. Okay. But what is it? Well, it's a variety of services. If you do go down the insurance road, in terms of buying an insurance policy of some kind, what they'll say, what the insurance companies will say today is, if you cannot do 2 of the 6 activities of daily living, which as you can see are bathing, dressing, etc. If you can't do 2 of those, that will trigger the benefits from your long-term care policy. Okay. The way I like to think about this is, think about the things that you do within 10 minutes of waking up in the morning. Okay. You get dressed, right? You go to the bathroom, you get out of bed. That's transferring, right? Just getting out of bed. Maybe you're taking a shower. Maybe you're eating right away and boom, you're out the door, right? If you're not doing that in the first 10 minutes, you're definitely doing it in the first hour to 2 hours that you wake up every day. Hey, if you just can't do 2 of those things, you need someone to help you do those things. Well, now you've triggered long-term care benefits if you went down the road of a long-term care policy. Going back to some points Ken made earlier, right? Who's going to need it? There's the 8% who think they're going to need it. But the reality is 70% of people are going to need it. Where do they get the care though? Now, I'm not going to take you through every single slide on this. I'll pause as we go through the different slides for at-home care, community-based care, et cetera, so you can have that information, especially if you're watching this on our YouTube channel. But and by the way, our YouTube channel, if you just look up Mission Financial Planners on YouTube, you'll see a host of videos out there. Just click subscribe to that, and then that way you're notified every time we post a new video. But where do you get long-term care? The vast majority of people will do it at home. Okay, at home care. What does that mean? That means your friends, your family, they're helping you. Maybe you've got someone who's coming into the home on a regular basis to help you out, right? That's what it is, okay? Community-based care is maybe you're going to a community center for the day, right? Maybe there's a social support network in place. Maybe there's health services. The big one, though, is respite. And the respite is not for you as the person who has the long-term care issue. It's for your caregiver. It's to give them a day off every now and then. And so that respite, that is a huge, huge component, I think, that you need to think about of whatever plan you're going to put in place. Because if a family member is going to be deeply, deeply involved in this, they got to have a day off every now and then. Maybe they just got to go get a new driver's license. They need time to do things every now and then that doesn't involve being with you 24 hours a day. So community-based care, that respite is fantastic. Independent living, we get a lot of questions about this, about continuing care retirement communities. What those are essentially is, I think of it like a college campus. You know, you pay to go there, right? And you might start off in your freshman year, if you will, using the college analogy, and you're active, you're out and about, you're healthy, you haven't had any major health issues. You become a sophomore though, you're slowing down a little bit. Maybe you need some more services there. You're a junior, maybe now something has seriously gone wrong. And then when you're a senior, yeah, it's a little more like end of life type stuff. They handle all that at a continuing care retirement community, or otherwise known as a CCRC. And they can be phenomenal. They're not cheap. Okay, I'll say that up front. They usually require a significant down payment to get in, and then there will always be additional service costs that you're going to deal with. Okay, so just keep that in mind. But they can be a fantastic resource. Assisted living, this is what a lot of people will do. So assisted living is someone comes in and helps, but you're like in a community, right? So it's residential. You've got your own place, but someone's coming in every day or every couple days to check on you, to make sure you don't need any help, to maybe help you with the things they know they're supposed to help you with. But that's what assisted living is all about. So what does all this cost? Okay, now, you know, this workshop is focused, you know, a little bit more on people really all over the country, because even though we had a bunch of people attend our San Antonio-based Social Security workshops in September, we've got people from California on this call. We've got people from Colorado, from New York. I mean, we've got people from all over the country on this call. So what's the average cost, first of all, of just healthcare, which Ken talked about this last week in the Medicare workshop. And if you haven't watched that, go to our YouTube channel, check that out. That's posted for you to be able to watch. Don't forget to subscribe when you're there. But the average couple is going to spend about $300,000 on healthcare in retirement. That does not include long-term care. That is your Medicare premiums, that's your deductibles, your co-pays, your your med sup policy you buy, out-of-pocket costs, right? All that's going to add up over a 30-year retirement. You want to think you're going to spend about $10,000 a year if you live 30 years in retirement. 1 year of long-term care on the low end is going to run about 52,000. On the high end, you're talking 110, 120, right? And these are just national averages. You can see here, for those of you in New York, you're talking anywhere from $6,000 to 10, 15 grand a month. And usually at this point in the workshop, especially if we're doing it in person, someone says, well, hey, my parents were paying 20 grand a month. Keep in mind, these are just the averages. Okay. If you've got the money to pay for, fantastic care, well, by all means do it. I mean, by all means do it. So long-term care is expensive. Ken, do you want to talk, since you did the Medicare workshop last week, do you want to talk a little bit about counting on Medicare and Medicaid?
Yeah, of course. So let's start with Medicaid. In order to qualify for Medicaid, you have to be fully financially destitute, less than $2,500 to your name and nothing but your homestead and a vehicle. And even then, there are instances in which having too much vehicle or selling it or whatever it is now puts money back into your account, which then might negate your ability to do Medicaid. And then typically someone in the chat might say, well, can't you use a Medicaid trust or shelter it? You could, but there is a really nasty look back period. And as you can imagine, with every IRS rule, the harder you try to find a loophole, the tighter they squeeze around it. So if you're on this call right now, Medicaid should just not be in your vernacular. It's not something you should be thinking about, especially when, because you are here, it's worth putting the time and energy to plan for it. Now, Medicare covers acute illnesses, things that happen for a short period of time that you will be better from. And so for Medicare, it covers, again, those minor instances, but it doesn't take care of critical care, things that are chronic care, things that will never go away or last for a very long time. So it does not help for getting in and out of bed because your back hurts, or again, you have leg issues or whatever it is. They will help. Medicare will pay for the surgery, will pay for the hip replacement. They'll pay for a portion of the rehab, but at a certain point, it's going to stop. And the traditional length of time that Medicare is needed, or that type of recovery is needed, is anywhere between 24 and 36 months, depending upon the injury, the gender, and the age at which the illness, or the chronic illness, happened. Matt, anything you'd like to add?
No, keep in mind too, if you think Medicaid is going to do it, it isn't. You're going to go to whatever facility they tell you to go to. And they don't care where it is. It's wherever they have space. So, at a minimum, like Ken said, if you're educating yourself by being in these types of workshops, you shouldn't even be thinking about Medicaid. You just really shouldn't. All right. Long-term care insurance, right? When long-term care insurance first came out in the 80s, there were tons of problems with it. Now, this says it was introduced in the 60s, but the 80s is really when it started to expand. In the late 90s, early 2000s, that's when you saw a lot of the standardization finally occur. So remember what I said before about, if you have a long-term care policy, what does it take to trigger it? 2 out of 6 activities of daily living. That really went through in the late 90s, that standardization went into place. So every now and then we do meet someone who says, yeah, the long-term care policy was a joke, whatever. Yeah, I'll be the first one to acknowledge some of the early policies that were out there did have serious problems. Some of those problems included premiums that just went through the roof. Arcane is really the only word I could use to describe it. Arcane rules for qualifying for your benefits. Policy cancellations. I mean, it was just a mess, So regulatory reform, like I said, happened in the 90s. Dementia, Alzheimer, you don't have to be hospitalized. You don't have to be getting skilled nursing. Upfront underwriting can't be canceled unless you stop paying it, right? and the premium increases, by the way, that still occur, they have to submit those to your state Department of Insurance. The state Department of Insurance has to approve the premium increase before that can happen. So original long-term care insurance, which is still sold today, Ken and I like to talk about it with people, to basically say, look, think of that like auto insurance. Your rates are going to go up over time. Even if you're a great driver, rates will go up. And when you get to the end of the policy, if you never needed it, if your car never got damaged in any way, shape, or form, right, and you're 98 years old and you finally stop driving, what's the insurance company going to say? Probably nothing, right? Because you're probably just going to cancel it and they're going to be like, okay, bye. Well, that's how traditional long-term care insurance works. The rates will go up over time. And if you never need it, you poured potentially a lot of money into something that didn't benefit you or your family in any way. Can it be a great resource? You bet. Is it probably the lowest cost option that's out there today? Yeah, it is. But I can count on one hand the number of people in the last 5 years that I've worked with who've said that's the way I want to go about the planning. And we'll make sure, like, if you sit down and have a discussion with us about this issue, we'll make sure you know what's available, right? But once you start seeing the weighing the features and benefits of this versus other types of planning, a lot of people don't go with it. Okay. So is it futile to plan? Ken, do you think it's futile to plan?
Never.
Exactly, right? Will things go as we think they're going to go? Never,
Never.
to borrow Ken's word. But if you do planning, you've got to that means you've taken the time to really think through the issue. And even if your primary plan doesn't work it out, you know how you're gonna, what your fallback position is going to be, right? Because that kind of thing happens. So some of the approaches on that have changed, I would say. So this improved long-term care insurance, that's really a result of the regulatory changes that occurred in the 90s. Okay. 2 out of 6 activities of daily living. Benefits are limited to long-term care. How those benefits work depend on the policy and the riders you get. Some of the policies will offer a cost of living adjustment. Some won't. Some will say it's a compounded cost of living adjustment. Others say, no, it's a simple cost of living adjustment, right? There's a lot of things you got to go through to figure out what's really the best fit for you. Ken, do you want to take a minute and talk about life insurance and annuities that have long-term care benefits?
Absolutely. So this has really come on platform within like the last 3, maybe 5 years, but really more so in the last 3, is that there are annuities with long-term care benefits. And the beautiful thing about some of these tools is that they do not have nowhere near the requirements in regards to your health that life insurance or traditional long-term care requires. So the bar to entry into some of these annuity products are fantastic, or rather very flexible. So if you might have a bump or bruise that might prevent you from getting some of the more traditional forms, long-term care offered through annuities you might transfer a portion of your IRA assets in a lump sum, and then at the time of your long-term care event, you're going to get a large percentage of that over the next 3 to 5 years or whatever it may be. That further amplifies what your deposit was. So it's taking $1 and turning it into $2 in a lot of instances in regards to covering your long-term care. So cutting your expense in half if you were to be paying for it out of pocket. So for our clients that were planning on doing it out of pocket, we showed them this option. Some of them say, no, thank you. But a fair amount say, okay, yeah, if I can pay less for it, I'll pay less for it. And again, none of the hoopla of around traditional underwriting. So again, every single month, there are new tools and features being brought onto platform. If you have not looked at it in the last 12 months and you're interested, it's worth having a conversation because there's always new tools. Go ahead, Matt.
All right. Thanks, Ken. All right. Other ways to pay for it. Okay. First of all, the equity in your home. You might do a reverse mortgage. You might do a HELOC. And for those of you who aren't sure what that term means, it's a home equity line of credit. Especially for a lot of our clients who own homes on the West Coast. and some of the clients out east as well. Yeah, you have a ton of equity in your home. Maybe you don't have a ton of other assets. This can be a tool to help you pay for it. We have a terrific reverse mortgage specialist that we work with. She'll be the first person to caution you, though, that keep in mind with a reverse mortgage, you've got to stay in the home, right? You can't move out, even if that means you're going to a nursing home. So reverse mortgages can work. You just got to make sure you understand some of the limitations that come with that. HELOCs are a little more flexible, right? We've got our federal interest rate cuts, hopefully starting next week. But we should see some better rates on HELOCs, within the next, 3 to 6 months, I would imagine. But a HELOC can be a great way to tap that equity in your home without necessarily having to deal with a reverse mortgage, right? Because you don't have to stay in the home. Some existing insurance policies don't have long-term care benefits, right? So what can you do? There's something called a life settlement where you can sell your life insurance policy to someone. Basically, a company comes in and says, hey, we'll give you X upfront for it. Accelerated benefits. So some life insurance policies will have a couple things built into them. One is the ability to build up a cash value over time. Well, what a lot of people don't know is you can pull the cash value out of your life insurance policy completely income tax free. So you could potentially avoid some of the tax traps that Ken was talking about earlier. So and that's all in IRC, Internal Revenue Code section 7702, that you can look that up if you want to. A lot of insurance companies, though, will have things like critical illness, terminal illness benefits built into them. Critical illness means, hey, I had a heart attack. Well, now I can access 25% of the value of my policy in a lump sum. Or terminal illness. If my insurance policy has a definition that says terminal illness is 6 months from 6-month life expectancy signed off on by your doctor, you can access 50 or 75% of your policy, typically, again, in a lump sum. Well, the thing is about those accelerated benefits, those are tax-free because they are considered, the reason the word accelerated is in there is it's the death benefit being paid early. That's all it is. And it's for a legitimate reason. Pre-tax savings, could you use your traditional IRAs and your Roth IRAs? You certainly could. If you have a spouse, right, or someone else important in your life who's going to rely on those assets, think carefully, right? Traditional IRAs, like Ken said, it's going to muddy your tax situation quite a bit because while those distributions are taxable, keep in mind, anytime you spend over 7.5% of your adjusted gross income on qualifying healthcare expenses, it's deductible. It's not an above the line deduction, no, it's a below the line deduction. So it's not like a refund, right, or a rebate. It is a deduction. Okay. Roth IRAs, again, boy, we really encourage you to hang on to the Roths as long as you can. There's just so many tax benefits that come with them, not just for you, but for the person who takes it over after you die. Hang on to those Roths if you can. HSAs, right? Those can work as well. But I would just say the challenge with HSAs is, most people don't have a ton of money in those, which means that they're not going to really have a huge impact on this financially. They can be used. I mean, don't get me wrong, they can, but most people don't have very big HSAs if they even have one. Okay, Ken, do you want to talk about self-funding and what that could potentially mean?
Yeah, and so I talked about it a moment ago of self-funding, and at the end of the day, it's saying, hey, I have enough income coming in. I think I have enough assets that are going to be there. But at the end of the day, what is the cost of doing it dollar for dollar, taking it from your accounts? And really, it's going to be closer to $1.25, $1.30 per dollar, just because of the taxable nature where the assets are likely coming from. But at the end of the day, it is an option. It gives you the most flexibility in regards to picking your facility, but it also gives you the most responsibility because you're the one that has to go find the facility, to make the phone calls, to schedule the appointments and everything else. One of the things clients like, we've had a couple of clients need it this last year when they needed to activate their benefits. A lot of the providers have a concierge service. So the second they get that doctor's note that's saying you qualify, they take over, schedule whatever appointments and coordinate the care. And it's just y'all's job to be at home when the caretaker comes in. But if you're self-funding, a lot of that responsibility comes on you. The big question that I'm seeing at when I look at this slide is, should you? Not if you could, but should you? Just because of that amount of responsibility and the consequences of towards your state, towards all the things we've mentioned before. Are we willing to deal with it? 7 out of 10 Americans are going to need it. Um, what is the cost of this care going to look like in 15 years when the majority of boomers are at the age that they are going to need it? Um, yeah, again, should you self-fund? Not if you could, because I believe a lot of you can, but should you? And I think that's a real, honest, earnest question that you could have with yourself, with your partner, with your family, but also with us. That's why we're here.
Great. Thank you, Ken. So when you're thinking about a plan, right? I'll say this, and Ken might, Ken knows I believe this strongly. When you get into your 40s, if you're going to go down the insurance road with this, that is the time to do it. And the reason why is, yeah, you're young. Yeah, you're healthy. Yeah, you probably have a lot of pressures financially, trying to save for kids' college, pay off, paying your bills, blah, blah, blah. All, yeah, you've got all that, right? But it is pennies on the dollar what it's going to cost you if you wait 15 or 20 years to do that planning. At a minimum, if you're going to use insurance, go get yourself a permanent, like a whole life or a universal life policy that has a long-term care rider built into it. At a minimum, go do that and make sure you keep that policy. And the reason why, folks, like for example, we're working with a young lady right now. She's 46. A policy like that's going to cost her $5,000 a year. I can tell you if she waited till 66 to do it, she'd be paying $15,000 or $20,000 a year. Get the smaller policy. Get this, get the right policy, but get it now while it's truly affordable. Okay. Marital status. If you're single, you really need to do this planning. If you're married, you really need to do this planning, right? I mean, you really do either way, but there's now more considerations, right? When you're single, it's on you and you got to have something set up. When you're married, there's always that, hey, my spouse will do it, right? You might remember from a previous slide, we said, have you ever seen an 85-year-old try to take care of an 82-year-old? It just doesn't work, right? It just doesn't work. What's your health like? Military service, family history, assets, other financial planning you've done. What's your legacy and estate plan? If you tune in for next week's tax planning workshop, you're going to see us talk about a tax scenario with this that begs an interesting question. Should I use my IRA or should I use my insurance policy? Right? And we'll talk about that next week. That's a teaser to get you to show up for next week. So the three main questions when you're thinking about that stuff: who's going to do the care, where are you going to get it, and how are you going to pay for it? That's it. Those are the three components. Who's going to do it, where, and how. That's it. Those are the three things you really need to be thinking about. If you don't have a good answer for one of these three, you need to rethink it. You really do. You need to rethink it. And we're happy to have that conversation with you to give you our perspective on it. Remember, everybody's situation is different. You can get care at home. And then Ken, do you want to take a minute as we get towards the close here? Does the plan have to cover every potential cost?
Absolutely not. Just
Right.
for a couple of reasons. One, your Social Security check is still going to be coming in. If you belong to a pension, that's still going to be coming in. You're probably not going to be traveling as much, so that $5,000 or $50,000 a year of travel budget isn't being used. That's going to cover it. Some of the medical expenses are going to be a deduction. As long as you're spending more than 7% of your AGI, you get to deduct those medical expenses off of your taxable returns. So there are tax benefits of having those medical events. Just by increasing what we would call your income floor above your Social Security, above your pension, whatever else you have, to help further mitigate some of those expenses, will protect your flexible pool of investments. That will help make things easier by providing a concierge or whatever it else may be. At the end of the day, some protection is better than no protection. One of my last vehicles, I mean, think about your spare tire. Some people, their vehicle has that exact same wheel as the other four as their spare. Other people's have a donut, and there are some vehicles that don't. I found out the hard way that not my current vehicle, but the previous one before that didn't have room for a spare. And I found out after I purchased it. Who would have thought to not ask that question? But nevertheless, that was me. But again, just having that donut will make things better. Do you need that fifth wheel that keeps things running smoothly? It would be nice to, but it's not necessary. Having just a little bit of coverage can go a very long way for you and your family.
Yeah, thank you, Ken. That is absolutely spot on. I mean, absolutely spot on. So is it a potentially thorny issue? Yes, it is. Keep in mind the 4 keys, right? 1, it's about getting you the care you deserve. 2, don't rely on the government for this. Medicare and Medicaid are not going to help you. 3, I get that the insurance companies really scared a lot of people off 30, 40 years ago. Folks, that was 30 to 40 years ago. And then 4, there's a lot of different ways to approach this today that, like Ken said, simply didn't exist 15 or 20 years ago. You have a lot more great options to be able to deal with this. So just remember, custom approaches. No 2 people are identical. And if you'd like, throw it in the chat. We can send this out to you. Get a hold of us, ask us for the long-term care planning options chart. It takes you through a lot of the benefits and potential drawbacks of some of the different scenarios that you could go through in order to plan for this. Last thing from and we'll keep the line open for just a minute here, but last thing from a call to action standpoint, if you will, what I'd like everybody on the call to do today is really 2 things. One is, the next time you talk to me or Ken or another member on our team, proactively ask us how we can help develop a long-term care plan for you. Proactively ask us that question. What's the question again? How can we help you develop a long-term care plan? Ask us how, okay? The second thing is, ask your friends and your family, what is their long-term care plan? And you will be surprised at the responses you get. Some people, like Ken was saying, some people will have it covered. Some people have not even considered it. And for all of them, please tell them to either contact us directly or at least go to our YouTube channel and click subscribe and watch this recording, because that will at least give them some information that they can use that will help them make a good informed decision. If you need to get a hold of either me or Ken, you can reach out directly at 888-339-0093. Once again, 888-339-0093. Otherwise, go to our website and just fill out the contact form for either me or Ken. We're happy to spend some time with you. Even if you just want to pick our brains, that's what we're here for. So Ken, any final thoughts?
The one thing I'll add to it, and this is the most difficult hurdle to come over for most households, is we're asking you to set up a tent and set up these umbrellas, even though there aren't any clouds on the horizon. Because the reality is that once the clouds start showing up on the horizon and it starts drizzling, it's really difficult. Your options are limited, if not zero, to have some of these things in place. To build it and to build a plan right, it has to be done with clear skies. And that's probably the hardest thing that some households need to do. But we're here to explain it in great detail of why it's necessary. Because again, 7 out of 10 of you are going to be needing this at some way, somehow. A little bit of planning goes a very long way. And I'll leave it at that.
All right. Thanks, everyone. We'll see you for next week's tax planning workshop. Following workshop, which is the last one in the series, is on estate planning. And keep in mind, as we get into these last 2 workshops, Ken, are you a CPA?
I'm not.
No more than I'm an attorney, right? So what we're going to be talking about in the next 2 workshops from a tax planning standpoint, we can't give you tax advice just like we can't give you legal advice, but we can help you with tax planning. We can help you with legal planning. We can help you understand how the decisions you make are going to affect you from a tax standpoint and how they can affect your estate. To actually put some of that stuff in place, you are going to need to talk to a CPA or tax professional or an attorney. And we have some great resources that we could point you to if you're going to want help with that. But next week, tax planning, following week, estate planning. Please reach out if you have any questions. Don't forget to go to our YouTube channel. Go to YouTube, look up Mission Financial Planners, click subscribe. You'll get our weekly updates and all of our financial education workshops as well. Thanks again, everyone, and we'll see you next week. Bye-bye.